less than $1 billion market cap, had flexibility to become free cash flow positive when they wanted to. I understood that Jeff was trying to build something way bigger than what people thought he was. Also, we had the benefit that in 2001, no one else wanted to talk to Amazon except us. And we owned 24% of it.
Wait, so you owned 24% of Amazon?
We did. And we didn't know there was a law in Washington that you can't own more than 20% of a company.
Of a company in
based
Washington?
in Washington, yeah. So, I don't know, our lawyers had to like go to Washington and file special things and get a special dispensation to allow us to own our 24%.
Welcome to The Peel. I'm your host, Turner Novak, founder of Nana Capital. Today's guest is Lisa Rapuano. Lisa is known for outperforming the market 15 years in a row. The first 10 with renowned investor Bill Miller at Legg Mason, the next 5 running her own fund, Lane 5. We get into how they transformed value investing in the 90s.
You're not going to get an edge by doing the same thing that everybody else does. You have to figure out a way to think about it differently.
What Lisa learned from Jeff Bezos.
Watching him struggle through some of the early challenges was very insightful to me. Like, okay, even the smartest, most committed person might fail.
What she taught Jeff.
And any company that can invest its capital above the cost of capital should do it all day long. If you can reinvest your money in further expanding your competitive advantage, you should be doing that, and even if it makes your financials look like crap.
Mistakes Amazon made after the dot-com bubble.
And I think Jeff would look back and be like, yeah, we should have never done that.
What she learned from Michael Dell.
It's very hard to do a massive transformation of a business in the public eye.
And what she taught Barry Diller at IAC.
And I remember Bill and I sitting him down and being like, so there's this thing called the internet. And it's going to be a big deal for you.
Before we talk to Lisa, I publish new episodes every week exploring the world's greatest startup stories. Subscribe and check the link in the show notes to make sure you never miss an episode. Lisa, welcome to the show.
Thanks for having me.
So you worked with a man named Bill Miller. You working together with him, you beat the market for something like 15 years. That's incredible. Can you just talk about that?
Sure. Yeah. So I worked for Bill Miller at Legg Mason Capital in the 90s and early 2000s. And he beat the market from 90 to 94 without me. I joined in 94. And from 94 to 2004, I was pretty much his right-hand person. And I think I can take a little credit for the beating of the market that he did in the Value Trust. I also started managing another fund at Legg Mason in 97. And for the 6 years that I managed that, I actually beat Bill also.
Wow, the double whammy.
And he did continue to beat the market for a few years after I left. But it was a pretty great time, pretty fun time. And we were just really had a lot of success and had a lot of fun too.
I was going to say, hopefully it was fun.
Yes, it was.
I think that's going to be kind of the common sort of thread of the conversation is, how do you beat the market? How do you be a good investor? And I know there's a lot of case studies, examples from that time, kind of throughout the course of managing the funds. I'm interested, I think maybe to start, you didn't grow up thinking you were going to be an investor.
No, I thought I was going to be a rocket scientist.
And your dad was also, right?
Yes. My dad was a rocket scientist in Apollo. He was in launch control, in Cocoa Beach, Florida, during the heady times when rockets were blowing up all the time. And
this is the 60s?
He moved there in 58. And yeah, I grew up there. I went to college in 1984. So during that whole time we lived there.
Okay.
And it was, space was cool. Space is cool again. Thank you, I guess,
Thanks,
Elon and Jeff, right? And NASA, they get some credit too. But yeah, it was cool and it was interesting. And I really thought that's what I wanted to do with my life. And I was good at physics and math, I thought. But it turns out not so much. So
yeah, you went to a school that didn't have the greatest physics program?
Yeah. So I went to Yale and they had decent engineering. But like I could have gone to like Auburn on a full swimming scholarship, right? And that probably has a more prestigious engineering school than Yale. But when I got there, thank God I didn't go to Auburn, because when I got to Yale, I figured out I wasn't actually that good at it. And I was, like, oh, wait, I took 2 years of physics in high school at Cocoa Beach High School, and that's nothing like this intro to physics class that I'm taking here with all these other smart people who are way better at it than I am.
Yep.
So I ended up not taking that route.
And then what did you do instead?
I majored in American Studies. I fell in love with, I had this professor, Bill Cronin, changed my life. He had a great class called The History of the American West. And it was about bringing together lots of different information from primary sources, cultural information, music, newspapers. It was a different way of studying history than what we did at Cocoa Beach High School.
So it was instead of like, here's the story that we're top down presenting to the kids, it was taking different pieces, like music at the time, to learn about the history that wasn't actually the narrative.
Yes. And it was really good training for being an investor, which I did not know at the time, but really good training because you were given all you could find information, weight it differently, come up with new strings of a narrative, new strings of a story, a different way of approaching something. And, that general approach was something that I used a lot in my investing career.
Interesting. Do they call that the mosaic theory now? Or
that's one of the ways. They also call it lattice work sometimes, or all kinds of different ways of putting it together. The mosaic theory was actually, if you want to know, it was brought up to try to counter inside information. So before Reg FD, you would say that you could have, quote, inside information if you put it together from a lot of different sources through.
So it wasn't someone just said Amazon is going to beat earnings, you should buy the stock. It was 3 different suppliers that were indicating maybe that they had higher shipments than normal and like something else that's not as insidery.
The business model, the forecast, the way that you think that it's going to grow, what you think the demand cycle is, how you think the stock cost structure is going to go, when the free cash flow is going to come, all of those things. It's like from getting it from lots and lots of different sources of information rather than, a few.
That makes sense. And then before you actually graduated school, or maybe it was kind of right as you were graduating, you thought you were going to be an Olympian, I think, and you didn't quite, like, how did that go?
Yeah. So I was a sprint freestyler at Yale.
Is this swimming?
This is swimming.
Okay.
Yeah. Sorry. In swimming.
So you just swim as fast as possible,
Correct.
Whatever
If
mode.
you saw it in the Olympics, it's the 50 free is the one that lasts 20 seconds.
It's just down the pool.
Like, boom. It's the most fun.
What was your style? Like, what was your form?
My form was kick like hell and turn your turn your arms over really fast and don't breathe.
Okay.
Just what they do now.
Okay.
But I think I kind of hit a curve of getting really good late in college. And let's be really honest, I didn't take it that seriously my freshman year because I was a little bit burned out and I didn't have a scholarship to worry about. So I just kind of had a little fun. Plus, also, Yale was really hard for me when I first got there.
Okay, fair.
And I went to Olympic trials in '88, and I was seeded 3rd going in.
Is that good?
That's good. That means that I had the 3rd fastest time at going into the 50 freestyle.
What do you need to qualify?
The top 2.
Okay.
Back then, and now it's top 4 or 6 because they have relays. It turns out my time was actually converted from a yards time, which is not something you're allowed to do anymore, which is I swam a lot of 25 yards and 25 meters was the Olympics, which is 1 long length instead of 2 short lengths. And turns out my turn is really good, and I'm not quite as good at the 50 meter as I am at the 50 yard. So I ended up tying for 19th. It was a great experience, and I enjoyed it, but I was nowhere close to the Olympic team.
So what was the backup plan?
There wasn't one.
Okay. What'd you do?
Let's see. Oh my gosh, this is hilarious. My parents, this is kind of goes into investing. My parents, who were not investors at all, and really like we'd grown up during inflation, and I remember being broke because my dad's like rocket scientist salary didn't go up while inflation was going up and gas prices.
They don't make a lot of money? I always assumed.
They do not make a lot of money. No, they're government employees basically.
Yeah, that's fair. So it was like you weren't poor, but it wasn't a lot of money. We weren't
poor, but during the inflation of the 70s, we were a little broke.
Interesting.
And my parents bought Krugerrands.
What is it?
Which are South African gold coins. Probably at the very peak of the market. Like the people going to Costco and buying gold bars right now.
Okay.
Same idea, right? Oh, no, it's inflation. Let's go buy gold bars.
Oh, they bought it to defend against inflation.
Exactly. Probably at exactly the wrong time. And that was the only savings they had left after, mortgaging the house to pay for me to go to school.
Wow.
Because I was supposed to have a full swimming scholarship, right? So they cashed in their Krugerrands, and I had $2,500 to like get myself started in New York City. And I moved in with a friend. Her parents lent us a studio for a couple months. I got the first job I could get.
So what was that? You were it was kind of related to investing.
No, I was a secretary.
Wait, wasn't it an investment firm?
It was.
Okay.
I was a secretary on Wall Street. So luckily
So
I was on Wall Street. And, I wrote checks and fetched coffee and took calls and typed letters and all the stuff that you did in the 80s. But it was a guy that hired women. He hired people, but generally they were women, and then would give them a promotion after 6 months. And so after 6 months, I ended up in research marketing, which is basically I supported the salespeople by kind of reading all the research and knowing what everybody was saying and being able to like say, hey, this client might be interested in that, and this client might be interested in that. It was sort of a support role for the sales team. But I got to read a lot of research, and so I started teaching myself finance. Interesting.
So you that was your training. You didn't really get any like academic training, but it was all practical. Okay.
No, I taught myself accounting first, and then
that sounds like a nightmare. I failed account. I got a D+ the first time I took accounting. Took it again and I got an A.
Okay. Well, see, because there's an aha moment with it, right? Do you remember when you had the aha moment of debits and credits?
It was after I started working a job, and it all kind of came together. It was the first time I took it. It was just like, this makes no sense.
Yeah.
Like this, I don't understand what any of this means. And just memorizing things. I think there's acronyms that I think kind of click for me, like debits equals assets and dividends or something. Like I think that was one of the acronyms.
Okay, I don't remember that one.
Yeah, and there was one like revenue expenses, debits or something like that was one of them. Yeah. Anyways,
I never learned those.
Yeah. So, but that's how they taught you in college in the early 2010s. I forget the year I took it for the first time, but the second time I took it was literally just like, oh, I have done this for a job. Like it makes sense now.
It does make sense. But it's a different language, right? And you have to have the aha moment. And so I did that, and then I just started, reading everything that I could read, learning what finance was, listening, kind of like informing myself. And yeah, so that was how it all got started.
And then Legg Mason was where Bill Miller worked. Mm-hmm. It was in Baltimore. Mm-hmm. How did you end up working for Bill? What's the story there?
Yeah, so I left Wall Street with the man that became my husband. He did not like Wall Street. He wanted to work on something tangible, he thought, but they did not want. He tried to get a job, and all the places were kind of like, yeah, right. You're not going to go from making, $200,000 to making 45. We don't believe you. And so he went to business school. And I ended up in Chapel Hill, North Carolina, where he went to business school. And I ended up getting a job with a money manager who was so kind to me. And he kind of let me do, I did the marketing, I wrote the brochure, I did the computers, blah, 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 blah. And I started the CFA program. So that was also the training that I had. The CFA program is, I think, a great program for learning, how to be an investor, or maybe not so much that, but how to be financially literate. Yeah,
it's definitely I feel like level one. So I did the first 2 levels. I passed the first 2. I took the third as I was trying to transition into VC. Mm-hmm. I took the test, but I didn't study. So if you know how that works, zero chance you're going to pass.
Yep.
I think I actually got below 33%.
Oh, goodness.
So guessing, I still did worse. But yeah, the first test is a finance undergrad degree.
It really is.
The second one is maybe a master's, but you tweak and go deeper on certain topics.
Right.
And then the third one, which I thought was just ridiculous. I didn't enjoy it at all. And it was portfolio construction of it's stuff I wasn't really that interested in.
Yeah. And it's gotten more and more technical since I took it.
Yeah. And the questions are absolutely ridiculous. Yeah. I just remember I'm never going to actually.
I had to calculate duration by hand for bonds. I had to calculate bond duration with a calculator and a pen and pencil, right?
Yeah. Which I don't even remember how to do that. I did know it a couple.
Yeah. Now you just press the button on Bloomberg and
Yeah. Well, that's the thing that I thought was really ridiculous with a lot of this stuff but again, it's good to understand how it all is calculated and what the computer's doing.
Yes, absolutely.
To get you the answer.
Absolutely. But it goes back to, and I tell people this all the time and they don't really listen to me, but I think finance is just arithmetic. And it's just understanding all the terminology is hard. Understanding some of the once you get NPV, it's just not that hard.
Yeah, that's fair.
It's
all
not
just
real
an NPV
math,
calculation.
It's not like hardcore math. And you can get an advantage with, learning Python and learning things that do make your Excel better and stuff like that. But at the end of the day, it's not high math. So it's conceptual, which I loved. And
because anyone could do it if you understand
right.
8th grade math.
Right.
You can do it.
Which is why I tell people you don't need to major in business. You don't need to major in finance. You don't need to major in econ. You can teach yourself that. You can major in econ to be an economist, but if a lot of people are majoring in econ because they think it gives them a finance edge, which I don't think it does. But anyway, back to the story. I stayed in Chapel Hill for a few years, and then my husband got a job at Black & Decker, which is in Baltimore. That's how we ended up there.
Construction company?
Yeah, they're the tool company. They've been bought by Stanley since then.
Yep.
But they have DeWalt and all those kinds of things.
Yep.
And so he got that job, and I started looking for a job in Baltimore. At the time, Legg Mason was tiny. The big firms were T. Rowe, and Alex Brown was by far the biggest.
In Baltimore or just generally?
In Baltimore.
Okay.
And there was no remote work back then. There was no internet. It turns out the only place I interviewed was Legg Mason, and the only job, and Bill and I hit it off, and that was that, right? I mean, everybody I knew him. It was just kind of a strange match.
And then didn't you helped him research a company that he already owned?
Yeah, I actually forgot all about that until recently. So as part of my kind of interview process, he was like, I own this company, Royal Appliance Manufacturing, and they made the Dirt Devil. I don't know if you remember, was Dirt Devil still around?
Yeah, I've seen it within the last couple of years.
Okay, I think it probably got bought, and it's probably a branded thing now. But at the time, it was like a big deal, but it was a one product company. Okay. And, it was the classic thing where the stock went up a lot when it was growing and then crashed and burned when, they lost a little bit of their edge and their sexiness.
Yep.
And he bought it when it looked really cheap on trailing numbers. Yep. And, he asked me to look at it, and I figured that unless they had more products coming, there wasn't much there. And so I cold called the director of marketing in the evening and just talk to them what's their product market like? What's their product line like?
Were you calling as an investor, or were you calling as a... I
don't remember. I really don't remember how I did this. I'm 25 years old or 26 years old, and I just had no fear, I guess. I don't know.
You were trying to make money. You're trying to just get the information
I wanted this
that you
job.
needed.
I called him, and I figured out that the product pipeline was terrible and non-existent, really.
Wow.
And the director of marketing was a clown, and so I told Bill what I thought of it, and I ran the numbers out.
Listening to this.
And he sold the stock, and it never went up from there. I think it went down. It ended up, getting bought out lower than where it was when he had it, and he hired me.
What all did you learn from Bill?
So I am not the same as Bill, just like I think all investors are different. We were a pretty good team. What he did really well is he was just inherently contrarian. Anything that everyone else hated, he was just drawn to it, you know?
Yeah, that can be really good. It can also be a curse, I feel like.
Yes, it can be. It can be both. And he was also... he's just brilliant. He's just a really smart guy. He reads widely. He doesn't only read investment things. He's a philosophy guy. So I learned a couple things. I learned one, that you're not going to get an edge by doing the same thing that everybody else does. You have to figure out a way to think about it differently, whether that's, you just have to fill your brain with lots of different mental models that are not the same as everybody else has. Two is that you have to look longer term than everyone else does. And again, I'm going to tell you these things. In 1995, when we were doing it, it was revolutionary, right? At the time, when I talk about it now sometimes, let's remember, it's just 30 years later, right?
These are poking points that...
Yeah, this is what everyone says now. But at the time, it seemed it was very differentiated, and it was extremely cutting edge. And I feel good that it's mainstream now.
Okay.
Right?
And you guys were sort of like value investors, quote unquote, if we had to give it a name.
Yeah.
Like what was value investing at that time?
Yeah. Bill took over from this guy, Ernie Keeney. Okay. Ernie passed away not like maybe 15 years ago. He was like the greatest man ever. He was just such a sweet, good-hearted, values-based man. And he had founded the Value Trust, which was the fund that Bill took over. Okay. And Ernie was the classic old-fashioned value investor. His big thing was called sales leverage. He wanted to buy something with a low price-to-sales ratio that had the opportunity for margin expansion. Okay. And literally that's all he did. Okay. And so he always owned a lot of cyclicals. He would own the car companies, the banks. He was very, very old school value investing, low multiples. Okay?
So it's basically the company produces this. For someone who's never heard of value investing before, you look at the financial statements they put out. You say the company produces this much revenue. These are the margins. This is how much cash it generates. And then typically when you buy a company, the very quick summary is people look at how much it generates and they pay like a rough multiple compared to the market
of something
of like, okay, this company generates $100 in cash every year. Mm-hmm. So we'll pay about 10 times that. It's worth $1,000.
Exactly.
That is like, and then so value investors, it's, you try to find, it's at a 10, let's try 8, or like, we'll only pay 5 times, we'll pay 500 for this, and like try to get a deal, right? Because it should be worth 10.
Right.
That's so like the basic
classic, the like multiples arbitrage, we would call it. Like if it's earning $1 and trading for 5, it's 5 times earnings, right? And you think that the earnings can go to $2. And even if it only stays at 5 times earnings, then, you got to double. But often when the earnings go to $2, the 5 times goes, the market decides it's worth more and sends it up to 8, 9, 10, 11, 12, 13 times, So, but I would say that Ernie was very multiples based. Ernie, he wanted low multiples. And so if you go all the way back to Ben Graham, he wanted multiples of book value. Book value has become less relevant in our intellectual property based world. And so we generally now are looking at price to earnings, price to EBITDA, price to sales, price to cash flow, whatever. But still very much very much multiples based. So that was still what value investing was in the 90s. Do you want to ask me how it changed or is changing or has changed?
That's what I was about to ask you. Okay. Yeah. So what did you start doing differently at the time? And then I'm curious, what do people think? Like, what was the pushback? Because now we talked about kind of like it's like no duh. Like, of course you should, be thinking about these things, but like, what was the feedback like at the time as you started to change? And then what did you start to think differently about?
Right. So this took place over multiple years. This wasn't like an aha moment where we suddenly figured something out. But when I first got there, I was doing sort of some more standard stuff. I think we owned Reebok and Nike. We owned the gambling companies. We owned, or the casino companies. I always called them gambling companies.
And I think I remember you told me that you couldn't access the 10Ks or investor relations pages of the gambling companies.
Because when we first got the internet, if you went in and searched, it was I think we owned Hollywood Casino or whatever it was that we owned, Mirage, all these things that we owned. And Mandalay Bay, back when it was independent, and you went and searched for them, they were flagged as gambling sites.
Yeah, so blocked.
Blocked. Yeah, okay. So we couldn't download their 10Ks and 10Qs for like the first year we had the internet at Legg Mason.
That's awesome. What year was that?
That was 95.
Okay.
Yeah.
And then you didn't even have email for a while, right?
No, I got us to get email at Legg Mason Capital Management because I was following the internet and I was following AOL and I was like, we need email. Email is a good idea.
Yeah. So what did you do instead of having email? Did you write letters?
Yeah. I made phone calls. When I first started, you had to write to the SEC to request 10Ks and 10Qs to be mailed to you.
Did you at least get them every quarter or did you have to ask each time?
No, you had to ask every time.
Oh, wow.
And
Okay.
and then you waited 2 weeks till you got them in the mail, and it was crazy.
So if you went to the SEC's office, got the 10K, read it, you had like a 2 week.
Yeah, I guess you could have done that. I never thought of that.
Interesting.
No,
Huh.
we never did that.
See, that's how you make money.
Yeah, that's how you make money, right? The time arbitrage. Look at you.
That used to be a thing. Now there's no time arbitrage. It's instant.
No, it's all instant, right? Yeah. But how it changed. So like, I would say that we started getting a sense that growth had value in the mid-90s when the whole...
Because there's these two ways of thinking, value versus growth.
Yes.
Value, you're getting a cheap price. Growth, it's growing really fast.
Right.
Momentum
And allegedly you don't pay any attention to the valuation.
Because it's just going
Right.
to keep going up because it's going to keep growing.
Right. So we thought that was a dumb differentiation, that things that are growing fast are worth more. And there is an intrinsic value for every company based on a lot of characteristics that may or may not be the multiple. And it was just, it makes so much sense now. But like, if the multiple was the value, everything would trade for the same multiple. So why do things trade at different multiples? Because they have different businesses, different growth prospects, different returns on capital, different economic characteristics that make them worth more or less.
Like everything should be priced efficiently based on how much risk you're taking to return like everything should trade at this like blended spectrum of like the price, the multiple, the growth, the returns on capital invested.
Right. So we went from going to you buy something at 5 times and you sell it at 10 or 12 times, earnings, cash flow, EBITDA, whatever, to let's figure out what the appropriate multiple for this business is. Okay. And maybe we're going to pay 12 times for it, which is going to look bad.
That's low today.
That's going to look really bad on your blended multiples in Morningstar, and they're going to put you in the wrong box. And, but we were finding value in people not understanding the durability of a franchise and people not understanding the growth prospects of something happening in the world, specifically the internet, right? I mean, that was the big thing at the time.
Was the internet a fad?
So
because I'm just curious, because today you literally you can't be a human without accessing the internet constantly.
Yeah. There were people that thought it was a fad.
Okay.
There were people that thought e-commerce was a fad, very much so. And it was in certain ways, right? Because there were lots of businesses that were unsustainable, just like when I know you do a lot of coverage of, AI and more emerging technologies now, which I am no longer as familiar with. But it was kind of like when people get excited about something, they overdo it. But that doesn't mean there's no there, right? So from 95 to like 98, there were lots of skeptics, but nothing was too crazy. There were lots of people thinking like, oh, that's not sustainable. The internet's going to go away. I mean, I remember Bill Gates said, I had the internet on my list. It was down here at number 10. And then I realized I had to move it up to number 1. Like that was 98 when he said that, right? So that was like after Netscape had launched and after all this stuff had happened. So I think that it could be easily dismissed in the early years. And then in the sort of Greenspan said the exuberance. Irrational exuberance. And I think he said that in 98.
That's how he described the internet?
Yes.
Okay.
And that was way before the real rational exuberance happened.
Because it was kind of like, somewhat sloping upward line to like a vertical line for 2 years.
Yeah. And there were a lot of fads. There were, there were lots of things that were unsustainable. There were lots of people just cashing in, lots of people playing the game, but if you found the people that were trying to build sustainable businesses, that's what we would focus on. And there were there's lots of money to be made. Yeah. But there were people that thought it was a fad. And then when it turned into a mania, it was much easier for them to dismiss it altogether. Those are like, see, I told you, look at pets.com. Yeah. And you're like, doesn't mean that the internet's not real, guys. Right?
Yeah. Meanwhile, Chewy, which is basically pets.com, is like a $50 billion company.
I know.
It's a lot,
I know, right? Yeah.
That's like the total market cap of the internet company.
How are they ever going to be able to ship all these things? How are they ever going to be able to do the distribution? It's never going to work. Yeah. It's like, well, you just have to think forward a little bit.
Yeah. Meanwhile, I think one of my favorite thing from that era is Bezos was doing a interview with a reporter, and they were like, you're an internet company. Why are you investing in, like, why are you opening warehouses? Like, you should be focusing on the internet. Like, I don't even know what that means.
Right.
Like, you should be like getting a better web presence versus like you're opening these warehouses, like that spends a lot of money. Why are you like, that's doesn't make any sense. Like, they didn't compute how maybe you use the technology, but then there's actually like, you need to deliver the technology that you're leveraging in some way.
Yeah, because reporters know better than Jeff Bezos, I think. Right? So
I don't know. I mean? You said it on me. So I'm interested. You guys made a lot of money on AOL, right?
Yes.
But it was actually it was tricky. Like, how can you tell me that story?
Absolutely, that was fun. So that was kind of my first big. I thought when I nailed AOL that would be the biggest investment hit I ever had in my life, because it was amazing. Because everyone hated it. Okay, so it went public, went up a lot. We did not buy it on the IPO.
What year? Like, can you just
I think it was
like
95.
Because I was 4 at that point. So.
Yeah. Oh, you were 4.
Yes.
Okay.
So I need a little bit.
My children weren't born yet.
Okay. Yeah. The average. I think the average listener of this podcast is between the ages of 31 and 35. There's a little younger. There's a little older.
Okay.
So we need a little context.
AOL was the first ISP, which stands for Internet Service Provider.
Okay.
And the way that you access the internet back then is you got these discs in the mail from AOL, and you downloaded the software onto your PC or Mac.
Yep, I remember that. They would mail you these physical discs of like 750 free hours or something like that.
Exactly.
Like,
and you would use them for coasters because you had a lot of them sitting around.
Yep. I think there's a stat there's like more of those DVDs than people in the US or something.
And I've seen there's actually an artist in Park City that uses them to make paintings. It's really cool. Anyway.
Oh, amazing.
But so the reason the stock crashed is so it went public on lots of enthusiasm about the internet.
Yep.
And then Netscape went public and launched the World Wide Web, basically. So like an actual browser versus
so AOL was like access the internet. AOL was like give you the internet. Netscape was access the internet.
Correct. On anybody's wires.
Okay.
So AOL had their own wires plus their own software and what we called the walled garden.
Oh, yep, I do remember that.
Right? And so they have their own little AOL Instant Messenger. And the reason the crash and burn is the emergence of a more open internet was evident, right? That was obviously going to be the future, and it was unclear how AOL was going to survive. And AOL had they had infrastructure, they had hardware, they had...
which was unsexy because like capital intensive.
Correct.
And got it. Okay, yeah.
And they were growing really fast, and they were capitalizing their customer acquisition costs, which means they would mail out all these discs and it would cost, let's say, $175 to get a new customer. And instead of expensing $175 on their income statement, which would show that they were
losing a ton of money.
Yeah, they would only expense, I don't know, $25 or whatever the lifetime value of that customer was estimated to be. They would depreciate it or they would amortize the cost over time.
Oh, yeah. Okay.
So it'd be $25 a year or $50 a year, whatever that was.
Isn't that kind of bad? You probably should be expensing it, right?
Well, at the time, the accounting rules actually were very clear that they had to do it this way.
Okay.
However, it wasn't good, right? I mean, it made them look like they were very profitable and they were burning cash like crazy.
Okay.
So all the shorts started coming on it and we're like, this is really bad. Look at all the cash they're burning. They shouldn't, it's a fraud. And it wasn't a fraud. They literally would.
It was a real product.
You could really figure out exactly what was happening. All the data was there.
Like the data in the financials?
Yeah,
or the data?
Exactly.
Okay.
Okay, well, they're capitalizing it and here's how much they spent. And if they expensed it, here's what it'd be. And here's their free cash flow, right?
So the narrative at the time was they're trying to like hide the losses on the balance sheet?
Correct.
Okay.
And there's a competitive problem. And, the walled garden, blah, 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 blah. And the infrastructure. So infrastructure, walled garden, and bad accounting.
Okay.
However.
That's legit. That's a good excuse.
Yeah. However, the internet penetration at that time was like 4% of the US, right?
Okay.
So there was lots of room and people have to get on somehow. So you can still use Netscape on your AOL connection. You have to get on there somehow through some ISP. And AOL was relatively affordable relative to, I don't know if you remember, but PSI was one of them. And for about one hot minute, they were the sponsors of the Ravens Stadium in Baltimore, where I live.
Okay.
And it was called the PSI Net Stadium, which we called the Pissin' Stadium.
Okay.
Until, PSI went out of business.
Okay.
And
there was Net Zero. That was one we used because it was free. It's what my mom could afford. And then SBC, I think.
SBC, all the cable companies did it.
Okay. They all had their own internet.
Yeah, but this was dial-up modems.
Okay. Yeah.
This was like, unplug your phone, put it in the back of your computer, have your mom yell at you because you're using too much time on the phone and her sister might be trying to call.
So this was before the cable companies got into it?
Yes.
Okay.
In the meantime, they were still growing really fast and they were about to go cash flow positive. So if you ran out the numbers and you uncapitalized the marketing expenses and you looked at how the cash flow was going to go versus what the earnings were going to show, you could see they're about to go cash flow positive. So we bought it on the thesis there's still a lot of growth. They were about to become self-funding and that, the walled garden would take care of itself over time. And
what year was this?
This was 96.
Okay. And you bought it, so it kind of went down for a little bit, right?
Yeah, it did.
And you kept doubling down?
Yes, we did. All the way down.
Okay. What was the lowest?
I don't remember the stock prices.
Okay.
It was a 13 bagger for us. I know that.
Okay.
By the time Time Warner bought them. I remember sitting at their analyst meeting. I think I just had my first child. I was running to the bathroom to pump. And in between, I was coming out. And David Rocker, who is a famous short seller, was sitting next to me in the front row with the financials in his hands, like the physical financial.
That's 10K. Intimidating.
Yeah.
Like, I've read this shit.
He's like an old guy, super famous. And I'm like this,
mom. A mom pumping.
Yeah, pumping. Yeah. He's like, you're going out of business. I've got the evidence right here. You're going out of business. And I was like, they're about to go cash flow positive. And he's like, no, they're not. They'll never. I was like,
yeah,
it's going to happen like 3 quarters from now. And, so once they went cash flow positive, all this accounting, then they changed their accounting, but they had to get permission to change their accounting. They changed their accounting. It was, all of these things kind of went away. And, not that there weren't still competitive issues, but they had a real business. And so from 96 to 99, we really just rode that one as far as it would go. At the same time, all of this internet speculation and crap was happening. Like I said before, we still knew there was a there, right? So it was always a matter of just like, is it gone too far yet? Has it gone too far yet? Has it gone too far yet? When Time Warner bought AOL, that was like ding, 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 ding.
That was close to the top of the market, right?
Beginning of 2000, yeah.
Yeah. What was the valuation of like the whole company or the deal? Was it like $100 billion or something?
You got to go look that up. I don't know. That was a long time ago for me. I'm not even looking at numbers anymore.
Okay.
So, but it wasn't.
It was like the biggest corporate deal of all time.
Yeah, it was huge.
Yeah.
And you kind of knew that Time Warner was going to screw it up because there was like
what? Okay, how so?
Well, because there was I have another funny story. Barry Diller, who runs IAC,
yep.
Right? Who's very savvy in the internet. At the beginning of my career, I owned Silver King Television, which he owned and controlled.
Okay.
And I owned Home Shopping Network, which he also controlled. And at one point, he tried to merge Home Shopping and Silver King. And so I remember being like a pivotal vote on this. And like people that were Silver King owners, it was a television network, hated the deal. And people that were Home Shopping Network hated the deal. And I was like, you can't both hate the deal. It's got to be good for someone, right? If you both hate it, it's probably a good deal, right? The negotiation, if everybody's a little bit disappointed, it's probably a good deal. So anyway, I got to know Barry during that. And then he was running QVC's HSN at the time, right? Both of them were together. And I mean, I remember Bill and I sitting him down and being like, so there's this thing called the internet. And it's going to be a big deal for you. And you've got to get it.
Like he's going to benefit from it?
All these other media companies don't get it. They're like, they really don't understand. There was like the whole transition from old media to new media was very, very clear.
Interesting.
And so you knew that Time Warner was they were doing it defensively. They were going to run it into the ground. All the talent was going to leave. It was going to be a disaster.
What was Time Warner at that time? It was Time Magazine and Warner Brothers.
Warner Brothers.
What did they
and the cable companies. All the cable companies.
They owned all of the cable companies?
Well, all the, I guess what's now Comcast. Yeah.
Oh, really?
Yeah, I think it was Comcast. Was it Comcast? No, it was Time Warner Cable. Or TWC. TWC. Time Warner
Is
Cable.
that what AT&T is now? Or
I'm not sure where it went. But yeah, they had been consolidating cable companies throughout the whole country for a long time. So Liberty Media and Time Warner were both the big consolidators in that.
Interesting. Okay.
But yeah, so that's why they were interested in AOL, because they had pipes too. And they had content too, right? And so it was like, oh, we can move it to broadband and all this kind of stuff. But yeah, we knew it would be a disaster.
And then you also benefited quite a bit from Dell. You were I don't know, early investor. I don't know at what point in like the post IPO, how big the company was, but I know you made a lot of money on that one too. What was the story with Dell? That's another one of those like, it's a computer company, like it's hardware,
right.
Why would you buy that? You know?
So in 95, when you all were
when I was 4.
When you were 4, or maybe
preschool.
some of you were not even fetuses yet. In 95, there was a actual soft landing in the economy. So they raised rates.
Yeah, this was like the only time they ever did it, basically,
it was
right?
Paulson, maybe? I don't remember the Fed chair's name, but I think it was, or maybe it was Greenspan. I can't remember. But so got a little overheated in 94, and they raised rates. And this is after a really long recession, right? I mean, it had been brutal for a long time, and then started to really go up. And in 94, it got a little overheated, and they raised rates. And so, as is normal, all the cyclical stocks went down, right? And
it's basically whenever rates go up, stock prices come down.
Yeah.
Whenever rates go down, they go up. That's like the rough TLDR for people.
Yeah, especially things that are cyclically sensitive, like manufacturing companies, steel companies, paper companies, anything that's, very cyclically sensitive. Technology was considered cyclically sensitive. It had historically been cyclically sensitive. Okay. And at that time, technology was IBM, mainframe computers, computer associates, big giant installed software bases, disk drives. That was kind of the whole industry.
Yeah, the internet wasn't a thing.
The internet wasn't
like barely even existed, barely even hobbyists at that point.
Exactly.
Okay.
And so Dell, we didn't realize how great Dell was until after we bought it. Okay.
Really? Okay.
Yeah. So, because we bought just like all the tech companies, we just were doing a cyclical trade. We bought Dell, Gateway Computer, which was another one.
Yeah. I remember those.
HP, Western Digital.
Which you bought all of like the.
We bought a whole bunch of them, right? Like just because we didn't know technology from our toenails.
But they just looked like good.
Yeah. And so then I was like, here's technology, Lisa. Go figure it out. That was my assignment.
Okay.
So I was like, all right, these are semiconductors, and these are semiconductor capital equipment, and this is what a PC is, and these are what, I literally had to figure it out from nothing.
Yep. And you were like youngish. So you're like in your 20s, right?
Yeah. Mary Meeker was a PC analyst at Morgan Stanley.
Okay.
I don't know if you know who she is.
Yep.
All right. She's like the mother of the internet now, right?
Yeah.
She was the PC analyst.
I should try to get her on the podcast, actually.
Yeah, she'd be great.
Interesting.
We bought them all. And then there were a couple of things happening. With Dell and Gateway, and so HP was sort of not doing as well. Dell and Gateway were doing really, really well. We were trying to really understand the differentiation here. And, so we bought them all at, 5 times cash flow or 5 times earnings, right? And there wasn't a ton of risk while we spent some time figuring out. Over time, we culled it down to, I think, Western Digital, Seagate, Dell, and Gateway were the main
Were Western
hardware.
And Seagate, were those like hard drive companies?
Hard drive companies, yeah.
Yeah, okay.
Yeah, I have one in my office. It's like a little 20 meg hard drive that I just keep there to remind myself that 20 megs used to be a lot.
Wow. And those were like the biggest tech companies at the time.
Oh, yeah.
A hard drive company. That's awesome.
Yeah. So as the internet started to emerge, we realized that was going to drive a lot more demand for PCs. And everybody wants email. Everybody needs a computer on their desk. Everyone now, not just the senior people or just the secretaries, right? And then we also started to, Dell was the first to start the made-to-order trend. And so they weren't making computers until you ordered it, which was going to vastly decrease the cyclicality. So when you have to carry inventory and demand goes down, right? Your inventory the value of your inventory decreases.
And it just sits there.
And your earnings blow up, right? You suck. It's so bad. This is why cyclicals suck, right?
But doesn't doing one-off production lower, you get less pricing power, like your margins are worse?
Well, no, not
scale?
at that time. They reinvented the way that you did the manufacturing.
How did they do it?
They had they were just an early pioneer of just in time, right? They worked with the suppliers to get a lot of things standardized so they could do a lot more plug and play. Just like now when people still build desktops for themselves, right? One of my nephews just did it. And it's like you just go buy the pieces and put them all together, right? Yep. They sort of helped that along by getting things standardized. Whereas before IBM would design in this big behemoth desktop. And it could be made by no one else, and it had to be made in a big factory. Dell got it, so it was a lot more like putting together Legos.
Okay, so I would order it. So there'd be like 1,000 people would order in a day.
Yep.
They'd put the order into the factory. There'd maybe like a bunch of different custom models.
All custom.
Okay, and then they'd ship them all out.
So the other benefit would be they got paid before they had to buy the parts, right? They got paid first. Then they would deliver the product later. So they started this negative cash conversion cycle. So their working capital was funding their business. They didn't have to raise as much capital. So the combination of the demand curve, the differentiated business model, the negative cash conversion cycle, and it was still only, I think, 12 times earnings when all the other value investors were starting to sell it. We were like, this is a no-brainer. We're going to keep this one. So we kept that for... Also, we probably sold it in late 98, early 99.
Okay.
But yeah. And then I remember when it went private.
When was that? Like mid 2000s or late 2000s?
Yeah. So they really were such a great, changer of the industry. But then, people copy it, right? People catch up. Things don't stay differentiated forever. And I remember, I said to Michael Dell, like, you could do this in the public market. You're stealing money from the public market. And he's like, no, I can't do it in the public market. I said, yes, you can. You just need the right shareholders. And he's like, nope. But like, look how much money he made taking it private and then taking it public again. Yeah. Right?
Well, he could possibly be true because people would have not given him the time of a long enough time frame.
Yes.
To you looking at the financials, like, this is dog shit. We're going to remove you as CEO and not let you do that.
It's very hard to do a transition. It's very hard to do a massive transformation of a business in the public eye.
So has anyone done that in the public markets that you remember coming across?
That's a good question.
Like, I'm just trying to think, who's pulled that off? Like, is Amazon an example?
Well, Amazon did, for sure. They made a massive transformation of their business in the public eye. And they just sort of said, look, we're going to go, I don't care where our stock price goes. I just don't care. Like, I'm not going to manage to that.
And when was the first time you bought Amazon?
The first time I personally bought it in my fund was early 2002.
Okay.
Bill started buying it in 2001.
Okay.
We met them on the IPO. They went public in 97 or 8.
And you didn't buy it before that?
Did not buy it. Mm-mm.
Why not?
It was unclear what the real business model was at that point. We thought they were brilliant. We started following it aggressively. I remember one of my analysts, Randy Bufumo, who is now my brother-in-law, he was like, I'm going to build a model. I'm like, you don't need to build a model. We'll never own this thing. But he built a model, which I still have a copy of. And just like, it verified that, it was not a good risk reward at that point. It was sort of in the peak of the frenzy,
Okay. So it was like maybe good business, but it just didn't matter because the valuation was just too high.
And the frenzy was so high in the market around internet stuff. We just didn't need any more of that.
Was Amazon one of the most drastically overvalued ones at the time?
I don't know if you remember. It was not even that it was overvalued. It's that nobody was even doing the work anymore, right?
Okay.
So this was the whole controversy around it when, people were like, oh, I'm just going to raise my target to $400. $400? Sure, why not? We know this thing's a piece of shit, but we're just going to do that because it's going up,
Yeah.
And despite the fact we owned a lot of tech companies and a lot of things that were, frothy, we weren't crazy. So we were trying to be selective, and we knew we needed to be selective. So we didn't buy it at the IPO. But we did start following it, and we did become, I became very good friends with the CFO, who was, a woman, Joy Covey. Yeah. Yep. So then when it was time, when it crashed and burned, it started crashing and burning in 2001. Because
it was down like 97%, like peak to trough, I think.
Yeah, something like that.
Okay.
Yeah. So it started going down in 2000. Well, I mean, it went down with the internet bubble, right? As everything did.
And it was basically just like the valuation multiples went from 50 times sales or whatever the number was to like 10 times EBITDA or cash flow.
And if you weren't cash flow positive, which they were not, your access to capital was drying up.
Okay.
Yeah. And so that's
scary. So you were probably just trading at like cash on the balance sheet plus like acquisition
when your access to capital dries up, your business goes away.
Okay. So, and they raised debt, right?
Well, yes. So first thing they did is they raised margins by raising price.
Okay.
And that was probably helpful, but probably was a mistake in retrospect.
Really?
Yeah. And I think Jeff would say that. I think he would look back and be like, yeah, we should have never done that. We should have never tried for higher margins. Yeah. Because like the mission is to give the best experience to the customer all the time.
Okay.
But that did buy them a little bit of time. Then they raised some debt in the European markets. And I remember when they did that, I was like, okay, that's going to,
what does that mean?
Well, that's going to help them get through.
Okay.
Like they're no longer at risk of
insolvency.
Of insolvency. Yeah.
And didn't they had good timing on it, if I'm remembering right? Like they got it pulled off. They got it pulled
off right before 9/11, I think.
Okay.
Yeah. And then 9/11 happened.
And wasn't the market closed for a week during 9/11 or something like that? Okay. Yeah. I think I was in 5th grade.
Yeah.
So yeah. It's like
okay.
But I remember like, I had a different experience maybe than somebody who was like in the market at the time. But I remember like that was like the world was going to end.
Yeah.
Right? Like it was kind of like a COVID type scenario where like the stock market
I've been through 3 world endings. 9/11, the world was going to end. Well, the internet wasn't, 2000, maybe 4. 1999, the world was going to end because,
Y2K.
Y2K. And then 2001, the world was going to end again because of... because of 9/11. And then the world was going to end in 2007-8. I actually thought the world might end in 2008. The financial world might end at that time. Yeah. And then COVID. So that's like, I'm not that old. I'm only 58, right? Yeah. I mean, that's a lot of world ending.
Yeah. Like a full lifetime.
Yeah. But so, after 9/11, then also consumer demand, like we went into recession. It was very scary about like, are people ever going to buy anything again? Are we going to go to World War III? What's going to happen?
Yep.
So that was when the stock really started taking another hit. And in 2002 sometime is when we really started, when Bill and I both started like loading up on it. So
why did you load up?
Oh, because, okay. I figured out they weren't going to run out of cash. I had a very good sense of what they were doing, which is now very well known, but at the time was like, what are you talking about? So they started with books, music, and video, right?
Yep.
And books, music, and video was a sustainable business. We'd never know for sure, but I became convinced that they had that business itself was a sustainable business, and that the reinvestment in the other parts of the business were what was making the free cash flow look so bad, and that they had some discretion over whether they were going to do those investments or not.
They could choose to make investments or not, yeah.
Right. And any company that can invest its capital above the cost of capital should do it all day long, because investing above the cost of capital is a really rare thing. Most companies can't do it, and most companies could do it and, choose not to. So it's like if you can reinvest your money in further expanding your competitive advantage, you should be doing that, and even if it makes your financials look like crap. So
how do you control for like investor perception at that point?
There's 2 elements to that. I think companies worry way too much about that.
Really? Okay. Mm-hmm.
I think you get the investors you deserve, right? If you run your company for value creation, people who value value creation, who are generally long-term investors who will give you the benefit of the doubt and understand what you're doing, will sit by patiently. If you're constantly managing to the street and
like short-term expectations.
Exactly. You'll get people that care about that. That doesn't mean you won't have some volatility, right? It's always, prices are always set at the margin, right?
Yep.
But, you know, if you know that you can sustain this downturn because your primary investors understand what you're doing, go for it. So we bought it because it was like, it was less than 1 times, I think it was 0.8 times sales. It was less than $1 billion market cap. It was, I believed, free cash flow positive in the businesses that mattered. So had flexibility to become free cash flow positive when they wanted to. Had huge growing potential. I understood that Jeff was trying to build something way bigger than what people thought he was. Also, we had the benefit that in 2001, no one else wanted to talk to Amazon except us. And we owned 24% of it. So we got to sit down with Jeff and Joy whenever we wanted to and have lots of fun conversations about all kinds of stuff.
Wait, so you owned 24% of Amazon?
We did,
like,
yes.
Did you, so getting to that position in the public markets, like, did you buy it all at once? Was it every week you'd buy like another 10 million into it? Like, how do you build into that kind of position?
You were just, I mean, basically, Ernie Keeney used to call it munching. You would just buy it on the way down.
Okay.
Because you can't generally buy something after. If you have a lot of capital, it's harder to buy something on the way up.
Because you move the price up as you buy.
So,
but if you're buying into weakness when other people are selling to you,
right?
You
don't.
Okay.
Exactly. So I think Bill. I mean, it's split many times since then. But Bill started buying it at 31, bought it all the way down to 4. I started buying it at 18, bought it all the way down to 4, and had a $6 average cost, which I think is 6 cents now.
Yeah, because it's been like split a bunch of times.
Yeah.
So your average cost basis was 6 cents on Amazon.
Mm-hmm. Yeah.
That's crazy.
Yeah.
And it's like it's like $1,000 now or something. I don't know.
Yeah.
I don't really look at stock prices that often, but
it's not $1,000. It's like $179 or I don't
so
know. I only look at stock prices once a month now.
Yeah, that was probably a split in there that I'm not remembering, but okay. But it's like $2 trillion company or something, right?
Yeah.
Wow.
So, but the thing that people thought, so because it had been cash flow negative and because it was so controversial, and I don't know why, but for some reason, it just pissed people off that anybody thought it was going to be okay. And so we just were it was very, very contrarian. And like, I remember my husband coming home from the golf course one time and he's like, this guy in the golf course, he was just going on and on and on about it. And I'm like, what does he know? You know?
So just like a random golfing buddy?
Yeah.
Like you specifically or the fund or just Amazon, the
just
stock?
Amazon. Didn't even know that Rich had, my late husband had any knowledge of it. But, you know, it was, you know, on the cover of Barron's, Amazon.bomb. It was, you know, very, very controversial. And it turns out we were super right, you know, and I think like, I'm very grateful that, you know, Jeff Bezos gave us so much time of his time, but also like he listened to what we had to say about building a business and we listened to what he had to say about his challenges. And at one point he told me, and I hope he doesn't mind if I say this, but one time he told me, he said, I think you knew more about Amazon than I did at one point. And I said, yeah, well, you put a stop to that really soon by stopping telling anybody anything.
So what happened there? Everything you just said, there's a lot more we could talk about with that. So
yeah.
He stopped telling investors?
No, as they became more successful, they really got more closed mouth, which is actually appropriate because you don't want to give away your secrets, right?
Yeah, and because it took a long time for offline competitors to realize the internet worked, right?
Yes.
Like they just thought Amazon losing money,
right?
No threat.
So when you look at a business now, I mean, if you look at any kind of business as a venture investor, the first question you ask is like, how is this going to survive against Amazon? That's the first question you ask if it has anything to do with
e-commerce.
AWS or e-commerce, right?
Yeah.
I mean, they're dominant now. So, yeah. So
what did you learn from him? And then maybe what did he learn from you? I don't know which one's better to start with, but.
Well, I mean, what I learned from him is that, and this has been reinforced, is that it's really hard to, he's a very smart guy who's also kind of theoretical. Like one time we sat at a dinner and we talked about this book called A New Kind of Science by Steve Wolfram, which is this book is about this fat. And I read maybe 100 pages of it. He read the whole thing.
How big? Know? Okay. So it's like 1,000-page book?
Yeah. And it's really complicated. So he's like very much in his head, very good at thinking theoretically. And I learned that like the practical and the theoretical are very far apart. And watching him struggle through some of the early challenges was very insightful to me. Like, okay, even the smartest, most like committed person might fail. And, might not be able to get it right, even though they have all the right ideas.
Was there like things he was not quite there on at the time when you think about like the practical versus theoretical?
Well, I think that he ran into the same thing that a lot of venture-backed companies have run into more recently, which is in the early years, capital was unlimited and everybody just said, grow. And so he didn't necessarily have his finger on the pulse of where money was being wasted, where cash was being burned when it shouldn't be burned. Even though Amazon was relatively frugal, you've heard about the desks.
Yeah, we've seen all those.
The door desks and all that crap. But it's still, when capital is unlimited, you make dumb decisions. That was a really big lesson for me to understand. Because
you probably thought, sitting in the outside, there's no way that they would be making bad capital allocation decisions. Like,
right, because they're so smart.
Each line item on the budget, they're on top of it.
Yeah, they're so smart. Yeah.
What was like a common thing, not just Amazon, but just in general? Like, it seemed like people were wasting money on, like, were they hiring too many people, or?
It's almost always, sometimes, I mean, there's the standard P&L stuff, right? Which is hiring too many people, taking the Acela when you can take the Northeast Regional.
Expensive travel?
Expensive travel.
Okay.
Or just like stupid expensive travel. Why spend twice as much when the product is only 5% better? So there's those line items. But the biggest thing is spending capital on projects that either have the wrong probability of success or the wrong return profile, or just growth at any cost. Growth at any cost is a big bad one.
And it's probably just because you have so much money on the bad projects, is you have so much money, you've got to spend it. So instead of only doing the 2 projects that are most likely going to work, you do 10, and 8 of them probably don't make sense.
And you don't do any of them well. And you waste money, and you don't think about their potential return profiles as well as you should.
And then the growth at all costs is to keep the multiple that you have. You probably need to continue to grow 30% a month, so you will back into that.
And your venture backers sometimes tell you to do that.
Yeah, 100%. I mean, that's basically how it works. I don't quite, for the companies I investing in, it's usually like, let's just figure out how to like make the product and like sell it to people. Like, that's the average, but it's definitely that we do run into that where you have to figure out how to get the next round of funding raised, typically, if that's what you're doing. So absolutely.
So one of the things that we were I think we were very helpful to Jeff and Joy and Amazon in general, was understanding free cash flow and understanding that like you are not necessarily needing to manage the current free cash flow, but when you're making investments, you're looking at what the cash flow return on investment is long term.
Did they convey that poorly or well?
They didn't. They just didn't understand it.
Like they didn't understand it internally, or externally they should?
Internally, they didn't really understand it. They didn't understand that cash flow was what created value. They didn't understand that basic part. They thought growth was what created value, because that's what, it feels like a lot of times.
Yeah.
And so I think it was one of his letters, the first line, after we taught him this, the first line of his letter for many years, I don't know if it still is, our free cash flow per share is, our free cash flow is X and our number of shares outstanding is Y. And these are the 2 things you need to know to understand the value of our business. And that was something that we spent a lot of time kind of working on with them. Okay. And they got it quickly.
Yeah.
But
I mean, they're really known as being they really focus on free cash flow now.
Mm-hmm. Yeah.
Yeah. So,
it's good, isn't it?
Yeah, that's good that you made that happen. Is there anything else we should maybe hit on with Amazon?
No, that's good. That's enough. I mean, yeah. I can tell you that it's the only individual stock I still own.
Yeah. So so you owned 24% of Amazon
in our funds.
In the funds. Did you how did you think about starting to trim that over time? How long?
I left in 2004 and we hadn't sold any. And so I don't know how they decided to do that.
Okay.
I know there were diversification rules that we had to go about. We ran into that with AOL. I think at one point it was 23% of my fund because it had gone up so much. You run into the rules. You can't have more than 20% in the top 3, I can't even remember what the rules are anymore, but yeah, you had forced selling. I'm sure they ran into some of that.
And didn't you say you had to do stuff with the state of Washington?
Yeah, we accidentally bought more than 20%, and we didn't know there was a law in Washington that was like that you can't own more than 20% of a company
in
based
Washington?
in Washington. Yeah, so I don't know. Our lawyers had to like go to Washington and file special things and get a special dispensation to allow us to own our 24%.
Wow, okay. And then that's like the only stock you own still.
Yeah. So
Right,
when I
okay.
left Leg, I sold all my individual stocks. I decided that I would just put all my money into the fund that I ended up starting a couple years later called Lane 5 Capital. And so I sold all my individual stocks except Amazon.
Okay. And
And-
why did you leave Legg Mason?
Why did I leave Leg Mason?
I know you started a new fund or joined a new fund.
I
So
joined
why
a new
did-
fund, and then I left there and started a new fund.
Okay.
I should have just started one right away. I didn't realize it's not that hard, but I was a little scared.
Really? Why were you scared?
I don't know. It seemed like a big job. I had only worked at Leg Mason, and it seemed like a lot of work to go find clients and start a hedge fund, and but it actually wasn't that hard. I just didn't understand how the business worked yet. But I was at Leg for 10 years. It was a great time. We were $3 billion when I joined. We were $30 billion when I left in assets under management. Our numbers were amazing. Assets were flowing in like crazy.
Because you were just like consistently outperforming the market every year. So people, it's pretty easy to sell that as a person that's helping you
Everybody
raise money.
wants you after you've been outperforming for a while, right?
Yeah.
Not when you're, Anyway, so as the way you make money in asset management is grow assets because you charge a percentage of assets under management.
Yeah, it's way easier to just raise more money and clip the fees.
Exactly. So we had a research team of 6 people that I ran.
Yep.
I had implemented a very robust and consistent process of valuation and the way that we communicated. I was really good at translating it in ways that Bill would hear it.
Oh, really?
Yeah.
Okay.
Because he's not like he's got his own view of things, and if it sounds conventional, he sort of immediately would reject it.
It's always like give me like the contrarian.
Yeah, give me something
take.
different, right?
Okay.
I want to and so I was pretty good at that with him, and I thought that was our secret sauce, right? Keeping it small, being able to be contrarian, not look like everyone else, and in order to grow the assets the way that they really wanted to, they were getting a lot of pressure they had to go to the institutional market, and a lot of pressure from the institutional market to have a bigger research department, to have more redundancy, to look like everyone else.
Because you have to be able to say like, oh, we have this like proprietary process. And we have like 30 people on the team that are, on top of the calls and the spreadsheets that we're making.
Yeah.
Okay.
So I didn't want to do that. I certainly didn't want to run a team of 30 people. I was okay running a team of 6, but 30 was too many. I like picking stocks and running funds, right? And so I just didn't want to do that. I thought, not that I only didn't want to do it, I thought it was the wrong thing to do. And unfortunately, I was right about that. I'm sad that this happened to them, but they did grow to 60 billion. They had hundreds of people. And then, when 2007 hit, their numbers went down and their assets flew out. And I think they bottomed out at 10 billion. So 10 billion is still a lot of money, but going from 60 to 10 is really hard.
Like when you say over a time you went from 3 to 10, but there's the 60 in the middle there. The 60 to 10 is tough.
Yeah, exactly.
Yeah.
So, they did recover from 2007 to some way, but unfortunately the whole firm has, been sold off in pieces now. And it's too bad.
You didn't know how easy it was to start your own fund. So it's like ultimately what you did. How did you go about starting your own fund? And this was in probably 2006?
6, yeah. So I went to another company called Matador Capital, and that was it was a good fit at the time, but the problem I had was that the people weren't my people. So even though my co-investor, he gave me the process and he gave me the funds, he wouldn't let me like manage the people the way I wanted to manage them. So that ended up not working. So I left there and I spent 2006 like getting everything arranged.
Yep.
And got back in the swimming pool. That was another thing that I did in 2006.
Like
I
literally
stopped swimming after college, and I started swimming again in 2006. I swam masters for a long time, and so I named my firm Lane 5 Capital Management because Lane 5 is my lucky lane.
Oh, and
because it's the second seed lane, and I always like being the underdog a little bit.
Is there 6 lanes in the pool?
This was in college. Yeah, there are 6 lanes in the little tiny pool that Yale still has, which was built in 1932, which is a whole nother thing. Okay. But most pools are 8 now. But in the pool I grew up in, and I grew up,
it's like the underdog.
It's the underdog. Yeah, second seed, come from behind.
Yep.
Anyway, why was it easy? So I had a lot of contacts, a lot better contacts than I thought I did. I had a lot of really wealthy people who knew me and who I had invested alongside. And so I lined them up to be my investors. So, including Bill, and including Jeff Bezos, and, some other very high profile people. And so I had a good core of billionaires that were funding me. So that wasn't as hard as I thought. And this is a problem, and I understand the world is changing a little bit, but you literally call up, the lawyer. He's cut and pasting your offering documents from somewhere else, charges you $35,000 or whatever they charge these days. And
I paid less than that, but more than you would think.
Yeah.
Yes.
And, and then you're in business as an LP or an LLC, and it's just, there's not a lot of barriers to entry. The hard part, and I had a very differentiated investment process. I knew exactly how I wanted to invest. I didn't want to do it like everyone else wanted. I wanted to do it like the way we had done it at Leg, and the way that I had learned to do it, and the way that I had outperformed. And so that part was super easy. I hired some people that I, had a lot of trust in. I had a good team. However, what was hard was even though I had these lovely seed investors and I, thought I had a differentiated product, money raising is the hard part. I had enough to do well for the 10 years that I ran it, and that was great. But it was harder long term to grow it and to be, a big sustainable business than it was to start it.
Interesting. And you were you had a different approach to management fees?
Mm-hmm. And no one cared.
Okay. So what was your approach that was different?
So instead of charging 2 and 20, which was what that was the market. That was the market.
So you charge 2% of the assets every year, and then 20% of any profits.
Correct. I decided to charge 1% of AUM. So 1% is my base fee. And then I was going to take my fee only after I beat the market because it was in a long biased fund, right? So I started it at 40% of outperformance I was going to take. And still, as I ran the numbers on all of my previous investments, it would have come out better for the investors this way, and also protect them more in the downside. But just being different isn't, at least back then, being different wasn't okay. I had a concentrated fund. There was lots of volatility. It was mostly long. It was, value based for sure, but didn't fit in the boxes. The allocators just didn't know what to do with me. And I didn't, and to be honest, I didn't want to spend a lot of time playing that game. Probably could have done it if I really put my mind to it, and didn't want to. So I had fun and did a great job for the time that I was doing it, but it wasn't, I got bored and I sent the money back after a while, and that was my first retirement.
So then what do you think is the right way to do that? Is that essentially how you think most people should do it, with the paying for specific benchmark outperformance?
I think that's a good way to do it if you're long biased, for sure. Okay. I understand that there's been a shift in the way the market is to people wanting stock pickers like me to just run a super concentrated portfolio, and that's what they hire you for. That didn't exist back then. They wanted me to fit into the box so they could have their Morningstar type 6-box allocation, and I didn't fit in the box, and they didn't know what to do with me. I like the low fee, higher percentage,
higher hurdle rate.
I like that fee, and I know there are people doing that and have been very successful. I also think that just fees in general in asset management are stupidly high.
Really? Okay.
Stupidly high.
So why are they stupidly high? Just like paint us. If I've never even heard this before,
I don't know.
Paint me a picture why it's high.
Okay. Why are they stupidly high? Okay. Think about any asset gatherer, a big giant financial management company like Edelman,
T. Rowe Price, Andreessen Horowitz,
right.
Tiger Global, hedge fund.
Just for showing up to work every day, they are taking 1 or 2% of their assets, right? Just for showing up for work. Yeah. And then when the market goes up, which it has been for a long time, they get that growth in their fees for doing nothing.
Yep.
And so look at the margins at these places. Like they're stupidly high.
So you're saying like the income statement for the asset management company.
It doesn't make any sense that there wouldn't have been more fee competition by now. And, and then you look at my hedge fund where I tried to cut fees and it didn't have the standard economic impact of lower pricing attracts demand, right? That doesn't happen. You ask people, what do you pay for your financial advisor? They don't know. And usually they're paying like 2.25%, like something dumb like that.
Yeah. And sometimes there's like hidden fees.
Yes. Plus all the hidden fees. Exactly. Yeah. And so no wonder most people don't beat the market, right? The fees it's so hard to outperform the market anyway. And then when you've got like a 2%, yoke around your neck before you can even get there, it makes it even harder. So anyway, I'm not sure how we got on that subject.
Well, an interesting way to go is you ended up investing in and then joining a company that was sort of in this realm, right?
Yeah.
It's called Facet.
Mm-hmm.
Can you just talk about that and why you were so excited about it and how that ended up going?
Yeah. So I retired from Lane 5. I was trying to figure out what I was going to do next. I'm spending a lot of time in my garden. And my friend, Christy Weiskell, who runs a Hopkins Technology Ventures, like all of their startup land, all their royalties and everything, she told me I was posting way too many pictures of flowers on Facebook. And she got me to come in and start advising startups on some stuff. And I met Anders Jones, who's the CEO of Facet. They hadn't started it yet. Facet, the idea for Facet, which I'm highly supportive of, is that most people don't get the kind of financial advice they should get. And even when they get financial advice, they pay way too much, or it's conflicted, or it's, just like it's sold stuff, and the way the market is structured is not very pro-customer. And so what Facet does is they charge a, flat fee. It's not based on AUM. It's loosely correlated with what they're doing for you. So AUM is one of those things, right? Mm-hmm. But they do all their investing passively right now. I'm sure that over time they'll add a greater level of access. But for most people who are, have less than $1 million and are just not making hundreds of thousands of dollars, that's perfectly that's exactly what they should be doing. You should
be in no real estate fund. Actually, you probably have your house, but you should be in no like alternative assets, no venture capital.
Exactly.
You probably shouldn't even have bonds if you're below a certain age. Like, you should literally just be like the stock market, the broad stock market, maybe like a little bit of a global tilt. Yeah. Maybe you get like
you're selling it for them.
You should literally be like the most basic, no fee, like
diversified,
like a Vanguard fund.
Lowest fund. Yeah. So we used a lot of Vanguard funds, a lot of iShares, things like that. And what attracted me about it is like, number one, it needs to exist. This needs to exist because so many people are getting taken advantage of.
So this is like someone who we'll say like 50,000 in their account, and they're paying like a couple $1,000s worth of fees, and that's like massive. If they can even
get somebody to take their account.
Okay, fair. Yeah.
And if they can go open an account at T. Rowe or they can open an account at Fidelity, that's fine. But they're not going to get any financial planning advice. They're not going to get somebody to tell them what they ought to do next.
So they're probably using like TikTok for their financial advice, which is like buy like Joe butt coin or whatever, like that, like Trump coin or whatever. Like,
right, exactly. I mean, there's so much misinformation. It's scary. Like financial literacy is really low, and it's scary for a lot of people. I just gave my daughter some access to some money to take care of for themselves, and they're terrified. They're just like, Mom, what do I do with this? I just ask you what to do. And I was like, no, that's why I'm giving you access to this money. It's not yours, but you're in charge of it.
So you like gave them a pool of your own,
Yes.
like opened an account for them to
Yes.
log into.
I just did it today. And
Interesting.
one daughter was like, this is really good. I have such anxiety about money. I should definitely do this. This is so smart. What should I start reading? And my other one said, girl, I am in college. I am not doing anything with that.
Yeah. Well, I mean, hopefully it's just like buy some index funds.
Well,
and
that's,
don't touch it.
exactly.
Like,
I was like, okay, put it in an index fund. When you're ready, we'll talk about it.
I mean, I think an interesting thing to do with like people learning about investing is like products that they're familiar with is like go buy stock in like Abercrombie if you like their clothes. And if you think they have a really good product, turns out Abercrombie outperformed Nvidia. Yeah. I think it was last year or this year or something. So like it makes it more fun.
It
like
does
instead of
make
just
it more
like
fun.
it's this.
If that's what gets you started, great. But educate yourself. And so what I liked about Facet is that it gave people a lot of advice. You know, like what are your goals? They sit down and talk to you like a rich person would get, right? And that's invaluable. So
is it like an app or video calls or
video calls. Yeah, all Zoom.
Do they have advisors?
Yeah, CFPs, all CFPs.
Okay.
So I love the model. I love the mission. I love the people.
And you joined.
I was the third employee, the third non-founder employee.
Okay.
I invested a bunch of money in it. I stayed for 5 years. I unfortunately had some disasters in my life. My husband passed away, and I couldn't deal with with the world anymore. So I retired, 3 years ago, 3 or 4 years ago. But they're still going strong. You know, they're still working on growing and getting customers. And I think it's a great thing. It's going to be a struggle because they are against, a lot of inertia in the industry where people just don't care about their fees or the quality of their product, which is bizarre. So
what did you learn then on the other side of the table? Like you were talking to Bezos and Joy and Michael Dell, like I'm an investor. I own like 10, 20% of your company.
Let me tell you how it's done.
Yeah,
Let me tell you.
So what did you learn on the other side? You're like, oh shit, I have to actually do this now.
Yeah. I would use a stronger swear word than that.
Okay.
Because you literally like, when you get on the inside, there is that moment where you're just like, oh my God, this is so much harder. And so my Facet experience was a little unusual. Look, we had a huge Series A, way too much, in fact, way too much money. We shouldn't have had as much money.
Really? Why is that? Why should you not have raised that much money?
Because remember what I was talking about before, how when you think capital is unlimited, you start making stupid decisions.
Okay.
I don't think that any of our decisions were stupid, but I think that in prospect, I think we tried to be thoughtful about them. And I certainly was kind of the bad guy in a lot of these things. Like, this is too much. We're doing too much. Yeah. We're going to run out of money. But there's a lot of pressure to grow. And, we didn't fully have the product market fit yet. We had the product market fit. We didn't have the go-to-market yet. We didn't know how the customer acquisition model wasn't fully fleshed out. Customer acquisition is really expensive. It's what, crushed a lot of people trying to do this.
Yeah.
So, we wasted a lot of money on things that if we had been more capital constrained, we probably wouldn't have wasted. So
like at the time though, did you feel like you were being somewhat reasonable compared to the market? Like, did you feel like they're doing this crazy stuff? Depends on who you ask. Like you.
Me?
Well, inside of Facet.
I felt like we were throwing money at stuff.
Really? Okay.
At some things. There were a lot, but there are a lot of constituents, right? A lot of really, really smart people making these decisions. I was just the CFO. CFO has only so much. My job is to report and give my opinion. It's not to make the final decision, right? So my personal view was we spent too much money on everything. That's kind of a typical CFO process, thought process, right? Yeah. However, I think there was, this was when capital was relatively free and growth, things were getting valued on price of sales of 30, 40, 50 times. Yeah. In retrospect, we wasted a lot of money, and I kind of knew it at the time, but at the same time, I'm not sure that a different decision could have been made. So when going back to your original question of what's so hard is instilling a value creation framework in a company is really hard because it's counterintuitive. Right? It's counterintuitive to know that not all sales are created equally, right?
So what does that mean?
If you spend $2 to get $1 of sales, it's not worth it, right?
You might not be able to, like, you may be just so deep in that you don't even realize you're spending $2.
If you spend 50 cents to get $1 of sales, maybe that's worth it if that $1 of sales is recurring for a certain amount of time. If you spend 10 cents to get $1 of sales, probably that's worth it, you know? But it's a matter of understanding what those dynamics are. And it's very, very hard to educate people on that broadly. It's very hard to understand those kind of economic concepts for people. I think people at Facet I think the senior people at Facet certainly understood that, but then you have to manage around it. You have to instill the right incentives. You have to instill the right mentality. You have to be frugal. You know, those are really hard things to do. And at the same time, I'm not sure. I also think that at different levels of development in a company, there are times to worry about this and times not to worry about this, right? When you're going for product market fit, it doesn't matter. Right?
Yeah, like when you're a early stage startup, you are going to do a lot of dumb things because you kind of, that's the point. Like you're supposed to do things that are probably not a consensus thing.
But there is a point at which you need to start thinking about conserving capital, and there is a point at which you have to have a business model, and you need to sort of experiment around the edges of the model instead of just absolutely 100% experimentation from the beginning.
So it's kind of like going back to when you talked about like Amazon's core business made money and they were reinvesting in new products that were going to make the whole more valuable. So it's the same thing with a startup. It's like a core thing that works.
Yes.
What are we investing in and burning cash on to make the whole thing a better business overall, a better product?
And you have to have a probability matrix of what's going to work and what's not going to work. And you have to think about risk weighting these things. And you have to put the right amount of money. I mean, it's just like managing a portfolio of stocks, right?
It's internal capital.
Yeah, exactly. You know, you have to say, okay, well, my risk reward on this is X. And so it deserves this size position. You know, and my risk reward on this is Y, and it deserves that size position.
So this might be like how many employees we put on a project.
Right.
Or
what is the budget for the project? What is the expected return? And when do we pull the plug? Or when do we throw more money on it? Those are kind of the 4 pieces.
Okay. So you're super passionate about investing, just broadly. I've seen studies that women are better investors than men. I know we were kind of talking about it a little bit. What is that? How do you react when I say that?
So it's a vast generalization with a kernel of truth in it, right?
Okay.
We also have a smaller sample set in women, right? Which is interesting.
That's true, yeah.
So maybe women who have made it through this industry of, you know, like whatever, Game of Thrones,
they just have to be really good.
They have to be really good. But I think the kernel of truth, though, is the studies that you're mentioning basically say that women are more patient, women are less. One of the things I like to do when I'm really stressed about investing is take my hands and put them under my butt and sit for as long as I can and don't do anything. Because sometimes the hardest thing to do is nothing until you know the right thing to do. The men tend to be a little more impulsive around those sorts of things. These, again, vast generalizations. But I do think that the evidence is that women trade less, women are longer term holders. They're more, the other piece that I found to be an advantage for me was, you know, I like talking to people. You know, I mean, like you get the classic sort of example of the Michael Burry guy from The Big Short sitting behind there acting all weird and playing the drums, and, you know, nobody wants to talk to that guy, right? But fair. You know, people like to talk to a personable young woman, you know? I mean, it's you do
that's fair. Maybe that's how you got the guy on the phone, the marketing guy.
Maybe. But, you know, and you also like, look, this is a dumb thing, but they remember you. You're the only blonde there. You're the only blonde woman there. And you ask good questions. Then, you further differentiate yourselves. So maybe they're better investors. But I think that the other piece that we address there is that, like, if they're better investors, why aren't they doing it?
Yeah. Should there be more?
Of course there should be.
So why aren't there?
Well, my favorite answer to that is because the men who run the industry don't hire them.
That is basically the answer, right? They
don't hire them. They don't train them. They don't mentor them. I think there's also an element of some women developing a fear of it in So I have one of my daughter's friends is studying, thinks she wants to go into finance, and she's at UCLA, and she's having a hard time. She's covering, she's surrounded by all the finance bros, and she's one of the only women there. And it's kind of hard to be her. Even though she's probably very good and probably will be a very talented investor if this is what she wants. There's just cultural pieces that make it difficult.
So what should I do if I'm listening to this? I'm like a 22-year-old. I'm in college, or like I want to, I'm 25, I'm doing investment banking. I'm like, man, I really want to get into, I want to get into this. Like, what do you recommend? And then maybe also, what do you recommend to someone like me or somebody who is in like a seat to hire those roles? How should we approach that?
Let me start with the hiring one. I like that one. That one's easier for me.
Okay.
So I truly believe that the greatest investors, if you look around, very few of them went a conventional path. And I think you talk about your unconventional path sometimes, right? But like when I hire, I try very hard. I will not hire somebody who like went to an Ivy League school. I went to an Ivy League school, but who went to an Ivy League school and then went to an investment bank and went to private school, as for when
like
they were
MBA
children.
Or something.
Maybe like MBAs. I'll never hire another MBA again, ever.
Oh no,
ever.
MBAs get just destroyed on this podcast. There's been a multiple episodes of people are like,
first of all, they've made a really bad financial decision to spend hundreds of thousands of dollars to get a degree that means nothing. But anyway, they come out thinking they know more than they do. And granted, like they do get well trained, but they're trained in a certain way that isn't necessarily the way you're going to do it. So to hire someone, you have to be willing to invest your time in them.
Yeah, that's true. No one talks about that. But I don't have anyone that works for me right now. I don't even have an intern, which I could probably get for free. But there's a time component, which you got to invest.
You do. And in fact, like I talked about my experience at Matador, I joined this firm that had been in existence for years. And the CIO had 7 analysts working for him, and none of them were going to take over the firm. And I was the same age as most of them. So why? Because he hadn't invested any time teaching them how to do the next level. He just would send them out for information and have it reported back. So he didn't invest in them, so he didn't have a successor. You have to be willing to invest time in them. And so that eliminates, you don't need to have somebody who already knows how to do a DCF. You don't need to have somebody who's already knows everything about finance. You don't have to have somebody who's been picking stocks since they were 5 years old, because then they have a view of what it's like, right? You need to hire somebody who's curious, who has shown determination and hard work. I actually like people that are from a little bit more, I like to hire liberal arts graduates. That maybe is a little bit self-reinforcing because that's what I have that I thought was helpful to me. Yeah. But I like to hire liberal arts graduates or engineers who have just a different way of thinking than I do.
Yep.
But you have to be able to train them. And so so when you then get the next inevitable argument from somebody like, well, we would hire more women, but there are no candidates. It's like, okay, where are you looking? You're looking at people with 2 years investment banking experience. You're looking at people from the business school at Wharton. You're looking at people from the business school at UCLA. Why are you looking there, right? I mean, there has to be a different way. I liked looking for somebody who had taken a risk in their lives and who were... And that showed determination and passion. I know that's really broad, but I think that's the if you start from there, and then you're going to look for personality traits that are going to fit with you, right? You need somebody who's different from you, but who you can get along with.
So how was that you and Bill? You maybe explained that a little bit earlier, but can you expand on that? How did you work well together? And then the differences, you probably made each other better, I'm assuming.
We did. Yes. I think we did. Okay. I think the evidence is that we did. We did better together than we ever did apart.
That's not true. You beat him
I did
5 years in a row.
You're right. I did beat him, but okay. So what we had in common I still remember one of the things that on my resume, I had this like skills section at the bottom, or just like this random personal thing, which I don't know if people still do.
Yeah,
that.
People have that bottom line.
Yeah.
Where it's like chess, boxing, YouTube videos or whatever. And
I was in a Victorian novel stage at that point. So I wrote and I've literally read every Victorian novel. And it was like reading Victorian novels. And so he was like, have you read The Moonstone? And I had not read The Moonstone. So my interview was on a Friday. So I read The Moonstone over the weekend. And so when I came back on Monday, I had read The Moonstone. So we could talk about The Moonstone. So we had lots of sort of broad interest in intellectual things. That was something that we had in common.
Yep.
We were exploratory, curious.
You also did something over the weekend, which was related to this job, which was probably like, oh, she's interested. She puts in more work than just
there you go.
9 to 5.
Yeah, maybe. And then, so there was that basis. And then, I was very green when I joined, right? So I learned his worldview, his valuation view. I learned from him. So I adopted a lot of his stuff. And I kind of like, what I was really good at is formalizing it, so he was really good at like, here's all the stuff. And I was really good at like, okay, let's put that in a framework and let's apply it in a judicious and, repeatable fashion. We were very different personalities. He was an INTP and I was an ENTJ. And, which is like a Myers-Briggs thing, right?
Yep.
So, but the N and the T part in the middle were similar. But okay, so P is perceiving, right? And J is judging, the last one. I don't know if you're going to want to keep this in there, but Ps tend to turn over ideas over and over again and look at things from all different angles and view, like always looking for optionality and always thinking about the next possibility. So he was super good at that,
okay.
But it could also be very paralyzing. And I'm a J, like, okay, I want to do that. We're doing that. Right. And so together we were a good balance.
So he was constantly looking at different angles and you were constantly doing the decisions.
Yeah. Well, yeah. Or helping, like saying, okay, so that means that we're going to, okay, we got to make a decision on this.
Yeah.
And whenever it would get a little out of hand and he would just be like turning over the decision over and over again or looking at new angles or coming up with a different thing, I would just say, Bill, your penis is showing.
Okay. That's the good play on words.
So anyway, but and the other piece that was really good is that Bill's understanding of the reward that you can get from risk was very well ingrained in him. He likes risk and he can price it, right? But sometimes he wouldn't do as much as he needed to do to get the true sense of how much risk there was. And I was really good at mitigating, like he probably made me take risks I wouldn't have taken, but I made him do work to understand the risk that he wouldn't have done, right? So I think like a good example is we were looking at credit card companies. I don't know what year, but they were all going out of business. And we're looking at these 2 credit card companies, one of which was Providian, and I don't remember the name of the other one.
Capital One?
No, it was one that went out of business.
Okay.
And so they were both like trading for, 0.1 times sales or some ridiculously low valuation. They're both trading like they're going to go out of business. And he was just loading up on both of them. I'm like, well, I think I'm going to do a little work here and figure out which one is more likely to not go out of business. So I bought Providian and he bought both. And the other one went out of business and Providian didn't. Providian ended up getting bought out, made 10 times my money on it. And it's just like an example of just, they appeared to have the same risk, but if you dig down, you can really price the risk a little bit better. So I was a little bit better at that part.
Interesting. Okay. So another thing I think I've heard you mention before, if you just go like stepping back to like the value investing, Buffett is kind of just this like classic value investor. Everyone tries to kind of emulate what he's done and his philosophies and his strategies. Can somebody be like Buffett? Like, is that a good idea to just say like, I'm going to be just like Warren Buffett?
You should never be just like anyone.
Okay.
So no. And Warren Buffett will tell you that.
Yeah.
He will say literally like, don't do what I do what you're good at.
So this is like a unique competitive advantage as an investor?
Exactly. So this came out like I was giving a presentation at the Value Investing Congress in New York. It was like a big thing back in the 2000s. And I think I titled it, I am not Warren Buffett and neither are you. Because everyone would get up there and talk about how they're like Warren Buffett, how they do, competitive, the moat, long-term, blah, blah. And even Buffett doesn't do exactly what Buffett says Buffett does. Yeah. Right?
He's basically like the 10th largest economy in the world. Like his balance sheet that he works with is massive.
But he also is, he evolves, he learns, he's very good at what he does, like obviously.
Yeah.
He also has been doing it so long that his competitive advantage from time is way more pronounced. Most people don't make it that long, right?
Yeah, true.
But so no, you can't be like Warren Buffett because you have your own strengths and weaknesses. And so the key thing to do, and just like I was talking about Bill, like Bill's really good at like identifying something that has a high reward and not so good at pricing the risk part of it, right? But that's how he's made a lot of money. Like he finds these things that are going to go up 15x. And I'm really good at like actually nailing down and lowering the circle of probable outcome, so that I have a much better sense of these things aren't going to zero, or I know what their probability of going to zero is, and it's worth it to me. So it's just a very different, it's worth understanding exactly what you're good at and what you're bad at.
Do you have a way to think through, or like a framework to think through of if I'm trying to figure out, like if I'm listening to this, I'm like, I wonder what I am good at. Like, do you have a good lens of thinking through like what could be a competitive advantage as an investor? This can maybe be also relevant to like a startup operator or founder. That's the majority of people that listen to this podcast are startup founders.
Yeah.
And then we had a little sprinkle of like just like everything else adjacent to that. A lot of investors too.
That's such an interesting question. I don't have a pat answer. I don't have an answer in my head right now. So let me riff a little bit and see what comes out.
Yeah.
Okay. So I think if you've already been investing, obviously the first thing you can do is look at what are your successes and your failures, right? And if you're looking at your successes and your failures, then you can be like, okay, so one of my weaknesses is I am a sucker for an extrovert. Like,
oh yeah, you told me that.
Absolute sucker. Like
okay.
if you're a good salesperson, and I mean a good salesperson, the kind of person that makes you feel like you're not being sold to, and you're charming and you're engaging, I like over-index to that, right? So I know this about myself. So I actually over time would lower the amount of time I spent with managements because I would give them too much credit if I liked them.
Interesting. Okay. That's super relevant in venture where you're making a bet on the team and it's just a great founder and you just love them
exactly.
so much.
Why do you love them? Do you love them because they make you feel good about yourself? A lot of times that's what it is.
Interesting.
They make you feel seen. They make you feel smart. They make you feel like you're so special, and you lose I lose my ability to see them intrinsically.
Yeah.
So, like looking back at your failures, I mean, I've made many mistakes in my investing career, and it's part of your investing career, but sometimes I'll get too entrenched in a thesis, and I'll be immune to new evidence, right? So I'll just be like, and I'll be kind of like publicly identified with it a little bit, and maybe I will put it in my investor letters, and so cutting bait doesn't feel like an option, and I'll just go down with the ship,
Interesting.
So
I've definitely had that before. I don't know. Do you follow Stitch Fix?
Yeah. I mean, I don't follow it, but I know the product, and our mutual friend Manas had an investment in it for a long time.
Yeah, so that's one of our common bonds is we both rode that all the way up and all the way down. And I think, like for me, I just think they didn't execute on this, obviously, but very interesting value prop is like people intentionally, you'll say, hey, deliver me products every month. It's closed, but like there's going to be products that you get online. They just show up and they buy them.
Yes.
And like, it's pretty incredible how well that core thing works. And so like rode it all the way up, and I probably should have just been like, wow, I got like a 6x on this in a quarter. That's pretty good. But I think you get like too tied into like, oh, I was like known for talking about this publicly, and the stock price goes up. So you think, oh, it's still working. Like you definitely get sucked into that.
Yeah. Well, especially on momentum. I have a little framework for that if you want me to tell you.
Yeah, I'm interested.
So I actually made this up for a friend of mine that had an NFT that she just like bought on a whim.
Okay.
Or she bought it because she was like, I got to figure out these NFT things. So she like minted one.
Fair,
and it ended up being one of the Bored Apes. And so it went up like a bazillion times.
Oh, wow.
And she was freaking out. So I was
Because
like,
she probably made like hundreds of thousands of dollars.
She did, yeah. So I was like, all right, make a framework, right? So like, right where you like, if it goes to zero, how will you feel? If you sell it, or if you keep it and it goes to zero, how will you feel? If you keep it and it goes to $1 million, how will you feel? And if you keep it and it just stays where it is, how will you feel? And then I said, all right, now pretend you've sold it. And say, if you keep it and it goes to, if you sold it and it goes to, how do you feel? And she like came up with this little matrix. I was like, okay, now probability weight those things. And,
most likely that it will go to zero, go up, stay flat.
Exactly. And so it ended up, she let it ride for a few more weeks and then she sold it and it probably went up another 30% after she sold it before it crashed and burned. Right. Okay. But she made a lot of money. She bought a house.
Nice. I had a little bit less skill. I had that with GameStop. So you probably saw Michael Burry like owned a bunch of it. Mm-hmm. I think that's when I first like heard about it. I was like, oh, I always like, you're like, okay, crazy idea. Like this like video game retailer that's like going out of business. This guy's he owns like 10% of the company. I think it was Ryan Cohen, the founder of Chewy. Yeah. Like beat Amazon, selling pet things online. It was like I think he was like starting to buy shares or something. And I was like, wow, this is super interesting. If they figure out this e-com thing, like I think my thinking was just like it would re-rate how it was trading. It would basically go from EBITDA to revenue. Yeah. And that was basically the thesis. It's a little more like, detailed than that. Yeah. But yeah, and so I bought some shares and like it was like the beginning of December of 2020, whenever the thing happened. Mm-hmm. And I think I got like a 10x in a month and I sold and it went up another 100% the next day. I basically sold a day too early, but I mean, I like the reason I sold was because I was like, this is absolutely ridiculous. Like my thinking was like it might start trading at 10 times revenue or like something like that. I forgot it hit that and I was like, okay. I made
the hardest thing.
Yeah, and like I was talking to my wife about it also, and she's like, "Why did you do that? Like, sell them? Like, that's a lot of money. You should get out of it." So, I think I kind of accidentally did that, where I went through that framework of like, wow, this is probably going to go back down. Like that feels like the 99% chance this is going to go back down much lower. I would feel really bad and I would just feel great. Like, wow, I think I made like 10 grand from it or whatever.
I mean, that framework only works on these really speculative things,
Yeah.
I mean, like that's not
the Bored
real,
Apes.
that's not a real framework.
Those are like
selling,
the definition of like ZERP day trading.
Yeah. But yes, you had to, I mean, the GameStop thing was there were other people that bought it on real fundamentals and then like, now what do I do? And you kind of ride it and trade it and
I think it was like there's a console cycle coming up. I think that was another part of the thesis too. Well, you go into those stores and they like smell bad. Like the carpets are gross. Like
they're in malls, or strip malls, or
it was just a challenge business. I don't pay attention to it other than like it comes in the news now because it's a meme.
Right.
Do you follow much of those like meme stock?
You know what? I don't really follow any stocks now. Okay. I really don't.
You're a ski instructor?
I'm a ski instructor.
Okay.
Yes, that is my job. I have to keep reminding. I went to this heavy metal concert in Phoenix a couple weeks ago, and we met the band. It's this band called Lords of the Lost. And my best friend from elementary school is like a super fan. Okay. And so we went to this thing and so we're meeting the band. He's like, what do you do? And I was like, I'm retired. And I'm like, that's a really boring answer. I was like, she goes, you're a ski instructor. I'm like, oh, right. I'm a ski instructor. Anyway, so I have to remember. So yeah, I retired from Facet and I also had been tired of the market before. it can really burn you out, and outperforming is really, really, really hard. And I had enough money and I'm not that greedy in terms of needing more. And so I mostly indexed and I still own Amazon. And I look at my portfolio once a month. At the end of the month, I look at my little spreadsheet and I log how everything is done. And then I like think a little bit and I think if I want to do something else. And then sometimes I do. I did recently raised some money for cash, and it's sitting in an account that I could trade and invest if I want to. I have yet to do so, but I have it because I feel I can almost, it's almost like, I've been gone from it long enough that maybe there are some things I want to do, but I'm not following any. I read the Wall Street Journal every day, and I like look at the markets at the end of the month, but that's about it.
Interesting. Do you have a single biggest mistake that you made? Could I recent, a long time ago? I'm just curious. Maybe it's something you already talked about. Oh,
my single biggest mistake was definitely investing in for-profit education in probably maybe 10. I don't remember when. Probably 10 or 11 in 2010 or 11.
Okay. How is it a mistake? Those are good businesses. The margins can be pretty good, right? Because they're basically scamming people.
Well, and they're not all. So I'd been through a bunch of cycles with them, right?
Okay.
I had owned DeVry 4 times. DeVry was one of the higher quality ones, less scammy, right, if you will. I knew kind of what the CD edges were. I'd also been short.
The CD edges?
The CD, the edges of them.
CD, the bad parts.
The bad parts, the fraud. And so I kind of, and then I've been short them. I've been short a lot of them. I've been short them all. I think I was long DeVry and short everything else in 2005. Okay. And so then they were going through, and they tend to go through these cycles, right? When college admissions go down because of, the cyclical thing, whatever, and admissions fall, and it's a fixed cost business and blah, 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 blah. So I invested in them. And then there started to be a regulatory cycle on top of it that I did not recognize was worse than ever before. So Dick Durbin had always been out there saying they needed to be re-regulated and blah, blah, blah. And I just, it generally had resulted in an improvement in quality. I am not anti-regulation. I think regulation must exist to preserve capitalism, right? Otherwise, we're all going to eat each other.
Yeah, there would be crypto that was the edges of we should have probably regulated some stuff would be everything.
Yes,
a lot of the financial system.
Well-regulated capitalism is the best thing. The problem is well-regulating things is difficult. I got too entrenched in the old business models. I got too close to the companies. I didn't recognize the regulatory changes, and I did what we talked about before. I was kind of publicly identified with them. I'd written a lot of letters with them, and I was just going down with the ship. That's probably my worst mistake.
How do you get off the ship?
You have an analyst who beats you over the head. And you listen. Okay. No, you just have to constantly try to not be immune to evidence, right? You really have to try to have an open mind and think. I think what happened with that is that I also had a couple of analysts who were similarly in the groupthink with me. We were all on the board, and nobody raised the flag early enough. You just, you have to, sometimes you just have to cut your losses. Sometimes you have to say, look, I can't see this clearly anymore. Okay. And so I'm just going to sell everything and then look at it clearly and decide if I'm going to rebuy it. Okay. But most of the time it's, a gradual process of the information eventually seeping into your thick head.
Yeah, that's fair. And sometimes just the price is hey, it's down 95%. You invest in this private company, it was a unicorn, and now it's worth less than the cash that was raised. And your equity zero.
Take the tax loss, right?
Yeah, exactly. Well, this has been awesome. This is a lot of fun. Thank you so much for sitting down.
Yeah, thank you so much.
And thank you for listening. Make sure to check out the show notes if you want to go deeper on some of the topics mentioned throughout the conversation. If you like this episode, it would mean the world if you liked, subscribed, commented, followed, and shared it with a friend who can learn from it. And if you don't want to miss future episodes, subscribe to my newsletter, The Split, in the show notes, and you'll get links plus a transcript for every new episode emailed directly to your inbox. Thanks again for listening. See you in the next episode.
Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts, to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.